24 hours ago, I told you the COMEX was going to engineer a price smash. I told you they would use the US-Iran ceasefire deadline as the perfect cover story. I told you they would run the stops and liquidate over leveraged longs right before the May delivery window opened. And at exactly 2:47 a.m., Wednesday, April 2026, it happened precisely as I described. Silver Flash crashed to $75.65 per ounce while most of you were sleeping. If you did not have alerts set, if you were not watching the overnight session, you missed the single most important price event of the last 3 weeks. And if you do not understand why that crash happened and why it recovered within 4 hours back to 94, where we are sitting right now, you're going to get completely blindsided by what is coming in the next 7 days. Let me start with the number that proves I was right. Yesterday afternoon, April 21st, silver closed at $76.50. I said in my evening update that we were heading into the most volatile 12-hour window of the year because the US-Iran ceasefire was expiring at midnight. J.D. Vance had canceled his Pakistan trip. Iran officially refused to send negotiators to Islamabad. I said that if the ceasefire collapsed, the COMEX would use that headline to flush out everyone who bought silver on margin expecting a war premium rally. And that is exactly what happened. Silver did not rally when the war risk spiked. It crashed hard. Here's the timeline. At 11:52 p.m. Tuesday night, Brent crude oil started climbing. By 12:38 a.m., it hit $98. By 1:14 a.m., Brent was at $102.40, up over 7% in less than 2 hours. That is the oil market pricing in the permanent closure of the Strait of Hormuz and the restart of U.S. bombing campaigns against Iranian infrastructure. In that exact same 2-hour window, gold dropped 3% to $4,600. This is not noise. And silver dropped 5% to $75.65. Read that again. Oil up 7% on war escalation, silver down 5%. That is not how markets work unless someone is deliberately selling paper contracts to suppress the price. Now, I want you to pay attention to what happened next because this is where it gets really obvious. At 2:11 a.m. Eastern Time, Donald Trump posted on Truth Social. He announced that the ceasefire had been extended. He did not give a new deadline. He did not outline terms. He just said that Pakistan's Field Marshal Asim Munir and Prime Minister Shehbaz Sharif had intervened, and that Iran now has time to present a unified proposal. Within 90 minutes of that post, Brent crude crashed from $102.04 back down to $88. Gold recovered to $4,100, and silver climbed from $75.65 back to $78.94. That is a $3.29 recovery in under 4 hours. So let me ask you this. If the ceasefire extension is real, if the war risk is actually gone, why is Brent crude still at $88 when before this entire crisis started in January, Brent was trading at $72? We are still $16 above the pre-war baseline. The Strait of Hormuz is still under U.S. naval blockade. Iran's oil exports are still completely choked off. 20 million barrels per day of global oil shipments are still restricted. Trump himself confirmed yesterday that the blockade remains in place even with the ceasefire extended. So the structural oil supply crisis has not changed at all. The only thing that changed is that Trump posted on social media and Pakistan made 2 phone calls, and that was enough to reverse a 7% oil spike and a 5% silver crash in 4 hours. Here's what really happened. The large institutional players who run the COMEX knew the ceasefire deadline was April 22nd at midnight. They knew that retail traders and small hedge funds had loaded up on silver calls and long futures contracts, expecting a war premium rally when the deadline passed. Those retail longs are the perfect target for a liquidity grab. The big players start selling paper contracts aggressively in the overnight session when volume is thin and liquidity is low. The price drops, margin calls get triggered, stop losses get hit, retail traders panic and sell, and the institutions buy back their short positions at $75.65, pocketing the difference. Then conveniently, Trump posts a ceasefire extension at 2:11 a.m. and the price recovers. The retail traders who got stopped out at $76 or $75.50 are now watching silver climb back to $78.94 and kicking themselves. The institutions made millions in 4 hours. This is not a conspiracy theory. This is how the COMEX has operated for 40 years. Now let me show you the proof that this was a paper manipulation event and not a real market move. While COMEX silver was crashing to $75.65, the Shanghai Gold Exchange physical silver price did not move. The Shanghai AM fix this morning came in at $90.89 per ounce. Yesterday it was $90.30. That is a $0.59 increase. While New York paper dropped over $4, Shanghai buyers are paying $90.89 for physical metal they can touch and vault. New York paper contracts hit $75.65 for digital claims backed by 13.2% physical coverage. The The spread between those two prices is now $15.24 per ounce. That is a 20.3% premium that Chinese physical buyers are paying over the COMEX paper price. In a normal market arbitrage, it closes that gap. If silver is $75.65 in New York and $90.89 in Shanghai, traders buy it in New York, ship it to China, and sell it for $15 profit. That flow equalizes prices. But that arbitrage is not happening. You know why? Because you cannot buy the silver at $75.65 on the COMEX and ship it to Shanghai. The silver at $75.65 is a paper contract. It is a leveraged bet. It is a digital entry in the COMEX clearing system backed by a fractional reserve of physical metal. The silver in Shanghai at $90.89 is real. It is allocated. It sits in a vault with a serial number and a chain of custody. The COMEX price is fiction. The Shanghai price is reality. And last night's flash crash exposed that gap wider than it has ever been. Now, let us talk about what Trump's ceasefire extension actually accomplished, because the media is calling this a de-escalation, and it is the exact opposite. Here are the facts. Trump extended the ceasefire with one condition. Iran must present a unified proposal. He did not say what needs to be in that proposal. He did not set a deadline. He did not specify consequences if the proposal is rejected. And within 6 hours, Iran responded. Mahari Mohammadi, advisor to Iran's parliamentary speaker Kaliba, posted on X and said, quote, "Trump's ceasefire extension means nothing. The losing side cannot dictate terms. That is Iran's official position. They do not recognize the extension as legitimate. They do not consider themselves the losing side. And they will not be presenting a proposal that meets U.S. demands." So we now have a ceasefire where one side says it is meaningless. The naval blockade continues. Oil remains restricted. And Trump himself said 2 days ago on CNBC, "I expect to be bombing because I think that's a better attitude to go in with. This is not peace." This is a temporary pause created by Pakistani diplomacy that bought the COMEX enough time to flush out over leveraged longs and reset the delivery pressure before May 1st, Notice Day, which is now exactly 7 business days away. And that brings me to the COMEX May delivery crisis, because this is the only thing that actually matters for silver's price over the next 2 weeks. Right now, there are 241.8 million ounces of open interest in May silver contracts. There are 76.9 million ounces of registered physical silver available for delivery. That is a 3.14 to 1 imbalance. If you hold a May contract and you want physical delivery, you must notify the COMEX by next Wednesday, April 29th. Historically, less than 5% of contract holders stand for delivery. But we are not in a historical environment. In January 2026, during the last major delivery month, 33.45 million ounces were withdrawn from COMEX registered vaults in 1 week. That was 26% of the entire registered inventory drained in 7 days. The coverage ratio dropped below 15%, and the exchange had to scramble to bring in metal from eligible vaults to cover the deliveries. If that happens again in May, the COMEX will be in full crisis mode. And here's the critical point. The flash crash to $75.65 last night was designed to prevent that scenario. By smashing the price and triggering stop losses, the COMEX reduced the number of contract holders who are willing to stand for delivery. If you bought silver at $80, expecting it to go to $85 on a war premium, and you just watched it crash to $75.65 overnight, you're much less likely to take delivery. You're more likely to roll your contract to July or just sell and take the loss. That reduction in delivery requests is what keeps the COMEX solvent. Now let me give you the number that nobody is talking about. The COMEX registered silver inventory has fallen from 240 million ounces in April 2021 to 76.9 million ounces today. That is a 68% decline in 6 years. At the current rate of drain, which is approximately 85,000 ounces per trading day, the COMEX registered vaults will hit 0 in 98 trading days. That is less than 4 years. Now obviously, the drain rate will not stay constant. As inventory falls, premiums will rise, and that will slow the drain. But the structural trend is unmistakable. The COMEX is being bled dry, and every major delivery month accelerates that process. The reason I am explaining this in such detail is because the mainstream financial media is not covering it. CNBC is not talking about COMEX vault levels. Bloomberg is not reporting on the coverage ratio. The Wall Street Journal is not tracking registered inventory drawdowns. The only people paying attention to this are the institutional players who are actively managing their exposure and the independent analysts like me who are watching this data every single day. And those institutional players used last night's ceasefire deadline chaos to run a textbook liquidity grab that shook out retail longs right before the May delivery window opens. Now let us talk about Tesla, because in exactly 6 hours and 12 minutes at 5:30 p.m. Eastern Time tonight, Elon Musk is hosting the Tesla Q1 2026 earnings call, and this is going to move the silver market tomorrow morning. Tesla delivered 358,223 vehicles in Q1. The consensus estimate was 365,745. They missed by 7,422 units. But here's the bigger problem. Tesla produced 486,863 vehicles in Q1. That means they built 5,263 more cars than they sold. That is a 14% inventory overhang. Tesla is making cars faster than customers are buying them. Why does that matter for silver? Because every Tesla vehicle uses silver in the battery contacts, the charging port, the power inverter, and the onboard electronics. If Tesla cuts production because of unsold inventory, that directly reduces industrial silver demand. And it gets worse. Tesla's energy storage division deployed 8.8 gigawatt hours in Q1. That is down 38% from 14.2 gigawatt hours in Q4 2025. Energy storage is one of the fastest growing sources of silver demand because grid-scale batteries require massive amounts of conductive metal. A 38% sequential decline in that segment is a red flag. Tonight, Wall Street is expecting Tesla to report earnings per share between 37 cents and 40 cents. According to Polymarket betting odds, the consensus is that Tesla will miss expectations. If Tesla misses, if Elon Musk gives weak guidance. If he says anything about slowing production because of the inventory buildup, silver is going to sell off tomorrow on industrial demand concerns. But here's the wild card. Musk has been talking about the Terab project. That is Tesla's planned 1 terawatt AI compute facility. Tesla's 2026 capital expenditure is already over $20 billion, but Terab has been excluded from that guidance. If Musk announces Terab funding tonight, if he says Tesla is building data centers that require vast amounts of silver for server infrastructure, cooling systems, and power distribution, that is a silver demand catalyst that nobody is priced in. The reaction tomorrow will depend entirely on which story Musk tells tonight. And that brings me to Boeing. Because this morning before the market opened, Boeing reported Q1 earnings and they missed. This is Boeing's third consecutive quarterly earnings miss. Expected EPS was a loss of 59 cents. Actual EPS came in worse. Boeing is one of the largest aerospace and defense contractors in the world, and they use silver extensively in avionics, radar systems, missile guidance, and satellite electronics. A weaker Boeing means weaker defense sector silver demand. We now have two of the largest U.S. industrial silver consumers, Tesla and Boeing, both flashing warning signs in the same 24-hour period. Tesla reports weak deliveries and a 38% drop in energy storage. Boeing misses earnings for the third straight quarter. If the industrial silver demand story is weakening, that puts even more pressure on the investment demand side to carry the market. And investment demand is directly tied to the COMEX delivery mechanism, which just got reset by last night's flash crash. Now here is the macroeconomic backdrop that makes all of this even more insane. The United States reported CPI data earlier this week. Headline inflation came in at 3.3%, the highest since May 2024. Monthly CPI increased 0.9%, the steepest monthly gain since June 2022. Gasoline prices spiked 21.2% in March, the largest single-month increase since 1967. That is a 60-year record. Core inflation, which excludes food and energy, is still at 2.8%, well above the Fed's 2% target. And GDP growth in Q4 2025 was 0.5%. When you have inflation at 3.3% and GDP growth at 0.5%, that is the textbook definition of stagflation. The Fed is completely trapped. They cannot cut interest rates because inflation is too high. They cannot raise rates because the economy is barely growing. And now they have no confirmed chairman because Kevin Warsh's confirmation is being blocked by Senator Tom Tillis over the DOJ investigation into Jerome Powell. And Powell's term as Fed chair expires in May. So the United States is heading into a potential war with Iran with stagflation, confirmed with no Fed chairman, with the FOMC meeting scheduled for April 29th and 30th, exactly 7 days from today, and with silver having just flash crashed to $75.65 overnight before recovering to $78.94 by morning. Let me give you the real interest rate calculation because this is critical. The Fed funds rate is currently 3.5%. Headline CPI is 3.3%. That means the real interest rate, the rate adjusted for inflation, is 0.2%, essentially zero. When real rates are zero, there's no opportunity cost to holding non-yielding assets like silver and gold. You are not giving up any real return by holding physical metal instead of cash. And yet, silver just crashed 5% overnight. That tells you the price action has nothing to do with fundamentals and everything to do with paper market manipulation. Now, let us talk about what happened with Warsh yesterday because his Senate confirmation hearing revealed something very important. Warsh testified before the Senate Banking Committee on Tuesday, April 21st. He refused to commit to holding press conferences after FOMC meetings. He said he is open to reducing the number of Fed meetings per year from 8 down to possibly 4 or 6. He proposed a complete overhaul of the Fed's framework, calling it a regime change, but he refused to give any details on what that new framework would include. And Senator Tillis confirmed that he will continue blocking Warsh's confirmation until the DOJ drops its investigation into Jerome Powell. Here's why that matters for silver. When Kevin Warsh was first nominated as Fed chair on January 30th, 2026, silver crashed 27% in a single session. That was the largest one-day drop in modern silver market history. Warsh is seen as an inflation hawk who wants to tighten monetary policy and strengthen the dollar. A stronger dollar and higher rates are bearish for silver. So every time there is war news, silver moves violently. And yesterday's confirmation hearing was supposed to be a formality. Instead, it turned into a political standoff. And Powell's term expires next month with no replacement confirmed. The uncertainty around Fed leadership is creating a policy vacuum at the worst possible time. And that uncertainty is being weaponized to suppress precious metals prices. Here's the part that should make you furious. Yesterday, U.S. retail sales data for March came out. Retail sales increased 1.7% month over month, the strongest gain in over a year. The mainstream media reported this as proof that the consumer is strong and the economy is resilient. But if you read the actual report, the fine print says that the sales increase was likely supported by larger than usual tax refunds. That means this is not organic consumer strength. This is a temporary boost from government transfer payments. Next month, when the tax refund effect fades, retail sales will drop. But the Fed and the media are using this one data point to justify keeping rates high and delaying rate cuts. And that narrative is being used to suppress silver right now, even though the underlying data shows it is completely fake. Now, let me tie all of this together, because I know I have thrown a lot of numbers at you in the last 12 minutes. Here's the situation. As of 2 hours Eastern Time on Wednesday, the April 22nd, 2026, silver is trading at $78.94. It flash crashed to $75.65 at 2:47 a.m. this morning, when the ceasefire looked dead. It recovered when Pakistan intervened, and Trump posted a ceasefire extension on Truth Social. Iran responded by saying the extension means nothing. The naval blockade continues. Oil is at $88 after spiking to $102.40 overnight. Shanghai physical silver is at $90.89, a $12.24 premium over COMEX paper. The COMEX May delivery is 7 business days away with 241.8 million ounces of paper claims against 76.9 million ounces of physical metal. Tesla reports earnings in 6 hours with 50,163 unsold cars and a 38% drop in energy storage. Boeing missed earnings this morning for the third straight quarter. CPI is at 3.3%. GDP growth is 0.5%. Real interest rates are 0.2%. The Fed has no confirmed chairman. Kevin Warsh just refused to commit to Fed transparency if he gets confirmed. If you are still sitting on the sidelines waiting for the perfect entry point, you need to understand that last night at 75.65 was that entry point, and it lasted for 90 minutes while you were asleep. The next entry point is not going to come with a convenient headline. It is going to come when the COMEX runs out of physical metal to deliver and the paper price becomes completely irrelevant. At that point, the only price that matters is what you can actually pay to get metal in your hands. And based on Shanghai's $90.89 fix this morning, that price is already 15% higher than what the COMEX is telling you silver is. The next 7 days will decide everything. May 1st notice, day is now exactly 7 business days away. If you hold a May contract and you want physical delivery, you must notify the COMEX by next Wednesday, April 29th. That is the deadline that actually matters. Not the ceasefire headlines, not the Tesla earnings, not the Fed drama. The real deadline is the one the institutions tried to reset last night with the flash crash to $75.65. They succeeded in shaking out some retail longs. They bought back their shorts at the lows. They bought themselves a few more days of breathing room. But they did not fix the underlying problem. The COMEX registered inventory is still at 76.9 million ounces. The May open interest is still at 241.8 million ounces. The coverage ratio is still at 13.2%. And the structural drain continues at 85,000 ounces per trading day. Every single day that passes without new supply entering the system makes the next delivery cycle more dangerous than the last. Now, let me give you the truth that the mainstream will never say out loud. The COMEX price is no longer the price of silver. It is the price of a bet on whether the COMEX can keep finding metal to deliver, and that bet is becoming more expensive by the hour. Shanghai is already paying $90.89 for real allocated silver. That is not a prediction. That is the market clearing price for actual metal that can be vaulted and shipped today. The COMEX is still pretending silver is worth $78.94 because the paper game has not fully broken yet. But the gap is now $12,000, 24 per ounce, 20.3%. That is the widest physical to paper premium we have seen in this entire cycle. In a functioning market, that gap would have closed within hours through arbitrage. The fact that it has not closed tells you the arbitrage is broken. You cannot buy the cheap paper silver and ship it to Shanghai because the cheap paper silver is not real silver. It is a leveraged claim on a fractional reserve that is running out of reserves. This is the moment the entire 40-year paper suppression system starts to fracture. The institutions know it. That is why they ran the flash crash last night. They needed to reduce the number of people willing to stand for delivery in May. They needed to buy time. They needed to reset the leverage before the vaults run dry. But time is the one thing they are running out of. 98 trading days. That is how long the registered pool lasts at the current drain rate, less than 4 years. And every major delivery month, like the one we are entering now, accelerates the timeline. The May cycle could drain another 20 to 30 million ounces if even 10 to 15% of contract holders stand for delivery. That would push the coverage ratio below 10%. At that point, the COMEX has no choice but to either declare force majeure or force a price high enough to bring new metal into the system. Either path sends silver dramatically higher. Now here's what you need to do in the next 48 hours. First, set alerts on both the COMEX spot price and the Shanghai Gold Exchange fix. The divergence between those two numbers is the real signal. When the Shanghai premium starts expanding again, the next leg higher has begun. Second, watch the lease rates and GOFO rates in London. When those start spiking, the paper market is losing control. That is your early warning. Third, decide your position size right now. If you are a physical stacker, this $100 dip from $85 to $75.65 was the entry you have been waiting for. The next one will not come with a convenient headline. It will come when the COMEX vaults are empty and the only price that matters is what you can actually pay to get metal in your hands. If you are looking at miners, the leverage on a move from $78 to $100 is 5x to 8x for quality primary silver producers. That is where the real wealth is created in these cycles, not in chasing the spot price, in owning the companies that produce the metal when the paper price finally catches up to reality. If you are a paper trader or options player, the next 7 days will be extremely volatile. The breakout above 80.50 with volume is your confirmation that the manipulation attempt failed. Below $76.50 and the institutions are still in control. Position size accordingly and never risk more than you can afford to lose in a single session. The most important thing is this. Last night at 75.65 was the moment the market showed you the truth. The COMEX price is fiction. The Shanghai price is reality. The gap between them is the profit that is waiting for those who understand what is actually happening. The institutions bought themselves a few more days. They flushed out some weak hands. They reset some of the delivery pressure, but they did not change the math. They did not refill the vaults. They did not stop the structural drain, and they did not close the 20% premium that Chinese buyers are already paying for real metal. The countdown to the May delivery crisis is still running. 7 business days. That is all that stands between the current paper price and the moment the COMEX has to confront the fact that it no longer controls the price of silver. The flash crash was their last move. The next move belongs to the physical market. And the physical market has already spoken. It is paying $90.89 in Shanghai, while the COMEX pretends the price is $78.94. That gap will not stay open forever. When it closes, it will close violently. And the people who positioned during this $100 dip will be the ones who benefit. The paper game is ending. The physical reality is taking over. And the next 7 days will decide who is on which side of that transition. Drop your final thoughts in the comments right now. Did you catch the flash crash? Are you adding on this dip? What is your target for silver by the end of May? I read every single comment. If this update gave you clarity, hit like and subscribe. Turn on notifications because the next 48 hours are going to move fast. The institutions have made their play. Now it is time for the physical market to make its move. The COMEX is fiction. Shanghai is reality. And the gap between them is the future. I will see you in the next one. Stay sharp. Stay stacked. And never forget, in this market, the metal always wins in the end.